Hello. Thanks for sticking with me. And if you're following through, this is going to be a video on the twin deficit that the U.S. faces going forward. So initially, I'm going to start out with talking about some of the high-level issues that are pushing us into this twin deficit and how it could be exacerbated over the course of the next couple of years. But then I'm going to also focus on the forecast for the 10-year Treasury that I have as my base case scenario, and how the twin deficit may affect the market's ability to absorb Treasury issuance, and also how the Federal Reserve's reduction in its balance sheet of both U.S. Treasuries and also mortgage-backed securities could have an impact, and then kind of discuss the inflation that could be associated with pushing yields higher, or also the U.S. dollar that could be associated with pushing yields higher as well, and then some of the ideas of why bond vigilantes may make an entrance, which I don't think they are. So some of the high-level things are just the demographics. There's about 5 high-level things. So demographics being the first, with the aging and slow growth of the working age population. We're obviously experiencing in the U.S. an increase in the median age, the retirement of baby boomers. We currently have low fertility rates, and over the last decade, we've seen a declining trend in immigration. That's having a slowing growth on the working age population. Some of what's exacerbating that is the low labor force productivity, which is creating a situation where trend GDP is basically growing at between 1.7% to about 2.1%. Obviously, you can expand the fiscal deficit to temporarily increase that for a period of maybe 12 to 13 months or 12 to 14 months, but it's not a long-term issue because of those things I just named. Then the second thing of the twin deficit is the mandatory spending associated with Medicare, Medicaid, Social Security, which will ultimately crowd out all the other discretionary spending in 2020 to 2030, both defense and non-defense. So it's not just a matter of saying, hey, well, if we're going to cut the government spending, we need to reduce the defense spending. It's really ultimately the mandatory spending that's driving all of this. And again, that's part of the issue with the twin deficit and the very, very large fiscal deficit and trade deficit that we have currently. So some changes to mandatory spending via Congress will be inevitable in 2020 to 2025. The other issue that's going to be a big issue that's tied to the twin deficits is the interest on debt. And we had a missed opportunity in 2017 via the border tax adjustment. So Congress' failure to actually implement and push that through, because it was ultimately a consumption tax to reduce consumption via imports and increase exports. And the reason that probably sounds counterintuitive and doesn't sound like a really meaningful thing in terms of the twin deficit, but it technically really is, has to do with the fact that the U.S. is in a situation where we have a significant competitive advantage in shifting the economy through a recession over to the export-led sector. And that has a lot to do with global current account imbalances and how those things are going to ultimately evolve and switch over the course of the next two to 5 years. I mean, it's going to be probably a very fast switch that people weren't initially anticipating. So the border tax adjustment would have given us the ability to cut the deficit and not run such a substantially large $1.1 trillion deficit this year and then $1.1 trillion deficit in 2020. So again, with no other alternatives, this ultimately leaves the U.S. with no other alternatives but to keep the tariffs in place on China and some of the U.S.'s other trading partners, because ultimately, I understand that tariffs act as a tax on both business as well as households, but you need something to slow the overheating in the economy that created the sizable twin deficit in terms of expanding the trade deficit and generating substantial increase in imports. So the only way to effectively do that is obviously to tax consumption, and tariffs are ultimately the easiest way. So it's counterintuitive again, but it's being done because the tax cuts increased the federal deficit. They led to overheating of domestic demand and ultimately a sharp increase in imports, which will continue to be felt all the way through Q1, Q2, and Q3 of 2019. I think it's going to peak at around Q3 2019. So there are also the fourth issue with this is the higher taxes, higher tax rates that are going to be felt in the future. via millennials, Generation X, and Generation Y, and they could be substantial increases in taxes. You sort of kind of don't know where they're going to be, but it could hurt household formation and consumption in 2025. The other issue, I think the fifth major issue would be the rising populism, and there's shifting winds associated with populism. Right now, populism is focused on immigration and protectionism, but populist fires tend to start in one place, with populists having zero control over where they ultimately end. And what I mean by that is that given the situation with the twin deficit, the mandatory spending that's going to make up a substantial amount of the budget going forward, and the aging of the population, it sets up a scenario where populism ultimately could shift towards mandatory spending programs, which would ultimately pit the young versus the old. And so, I kind of wanted to start with those high-level things as to how they relate to the 2019 deficit and where Treasury yields are ultimately going to be, and the impact of inflation and the trade deficit, and the weakness ultimately toward the second half of the year in the dollar is going to affect all of that. So in Q1, my 10-year Treasury, I have it at about 2.8%. In Q2, I have it at 2.7%. In Q3, I have it at 2.5%. In Q4 at 2.25%. So for the full year, I think the 10-year Treasury is going to be about 2.56%. Core PCE, I'm looking at 1.8% for the first quarter, 1.8% for the second quarter, 1.75% for the third quarter, and 1.65% for the fourth quarter. So I'm looking at PCE gradually again falling below where the Fed would like it at the 2% anchored area to about 1.75%. Then the federal deficit, obviously, I have that increasing as a percentage of GDP throughout the course of the year, with the largest increase is going to come during the third quarter of 2019. And I think that's where you're going to get the largest widening of the trade deficit, and it's going to happen at the same time that the dollar is weakening. So I think the dollar starts to weaken in Q2. So if you listen to some of my other videos, you'd have heard that my expectation is for a couple things happen in the quarter two that should possibly surprise the market. In April, I'm assuming that there's going to be production cuts from the Saudis because of 1.2 million barrels because of the global oil war that's taking place isn't enough to offset declining revenues from oil for them unless they were to enact another production cut. So Q2, and that's ultimately obviously going to have an impact on inflation expectations, but I don't expect it's going to be a very wide. It's not going to drastically shift inflation expectations super high over the course of Q3 all the way into Q4, even with the fact that the labor market is continuing to tighten, and labor conditions continue to get better throughout the course of Q1, Q2, Q3, Q4, all the way into that first quarter 2020 recession that I see negative growth for GDP and negative growth for the second quarter of GDP as well. So having said that, I think there are some issues with absorption in the market, but we're going to go into just the 10-year Treasury in terms of the yield, the supply, and general yield curve flatness is probably likely to play out through the remainder of the rest of the year, and eventually that will morph itself into an inverted curve at some point. So it's also dependent on Federal Reserve policy. If the Federal Reserve were to remain extraordinarily accommodative, there's some risk in terms of extreme devaluation on the U.S. currency. And if there's a very large downward adjustment in the U.S. dollar due to Fed remaining extraordinarily accommodative through 2019, which means I have a base case first hike of 25 basis points in May. And then I see them that kind of being the end of it at 275 basis points. That sort of being the end of the hiking cycle. But it could lead to a deceleration in the combination of that being extraordinarily accommodative and the deceleration in US GDP in the second half of the year could lead to a sharp increase in inflation expectations, which again would just exacerbate the effects of tariffs and increase in wage growth, and also that Saudi production cut. So there's a possibility that could happen and drastically increase inflation expectations, but I don't think that's very likely. But it could also change the risk return on treasuries and also lead foreigners to demand higher yields on the debt. And then that goes to the absorption issue in terms of the Treasury's issuance. And if the market, the domestic market, meaning U.S. banks and insurance companies, aren't able to absorb, will central banks from foreign countries step in to absorb the Treasury issuance? And it's very likely that the because of the considerable surpluses that still remain in the global economy, because of global current account imbalances being heavily tied to the U.S. consumer and the U.S. consumer, and in terms of corporations and households shouldering a substantial amount of that, it would lead me to believe that there's going to be enough foreign demand for U.S. Treasuries going forward, even though the twin deficit is pushing out, $1 trillion in 2019 and then $1.1 trillion in 2020. So I still think that there's going to be a substantial amount of demand that will be able to effectively absorb it. So you won't get the sharp bond vigilantes increase in yields. And there's some other things too that could drive that too. The U.S. corporations are still cash rich, so households may not have a lot of savings, but U.S. corporations have a lot of savings, and they could actually play an effective role in soaking up and absorbing some of the U.S. Treasury, especially the issuance of bills and other shorter-term U.S. Treasury debt outside of notes and bonds. So in general, any investors looking for high-quality liquid assets are going to play a very large role in absorbing the decrease in the Fed's balance sheet of Treasuries, as well as the U.S. Treasuries issuance of Treasuries. The other issue, and I'm going back to the Fed's balance sheet, is the reduction in mortgage-backed securities. That is likely to have a bigger role on the market, and that's likely to be felt through the fact that mortgage-backed securities carry a lot of negative convexity and also negative gamma. And when it's housed on the Fed's balance sheet, it's not housed on private investors' balance sheet, which means ultimately volatility will rise due to private investors having to absorb and then also dynamically hedge mortgage-backed securities via shorting U.S. Treasuries and also engaging in interest rate swaps to limit their risk. So mortgage-backed volatility will likely spread to other asset classes, again, due to the Fed not putting it on its balance sheet, because the Fed doesn't hedge any of that, and the Fed really doesn't care about the negative convexity or the negative gamma exposure when it's on its balance sheet, versus the private sector, which actually has to substantially care about those issues and pushes more volatility back into the market. So the Fed suppresses it when it's on its balance sheet, but once it moves off the Fed's balance sheet, the hedging that takes place in the private sector is definitely going to lead to more volatility going forward through Q2, Q3, Q4 2019. Also, in any situation in which slowing growth or an economic shock that significantly decelerates U.S. growth, like I have a base case where we're at 2% and we're growing, but there could be a worst case scenario where GDP substantially, for whatever reason, there's a shock that no one anticipates, and it really puts a lot of pressure on GDP and leads to a even faster deceleration in the economy, which ultimately puts pressure on yields, because there would likely be a sell-off in the equity market, which would shift, which would have an effect on the wealth, would have a direct psychological effect in terms of the wealth effect, and shift a lot of investors into treasuries, as well as not only domestic but also foreign, if it was a global situation that had global impacts. And if that were to happen in terms of mortgage-backed securities, obviously the spread would widen against treasuries, but it could put it in a situation, if interest rates fell too low, there's some prepayment risks associated with not only the private sector but also the Fed, because it would basically it could potentially have people refinancing and basically taking those mortgages out of the assets on the balance sheet for the Fed. It doesn't seem likely that that's going to happen, but that's just an idea, throwing it out there, that would reduce the size of the Fed's balance sheet to something that they wouldn't want to happen, because they would obviously have no control over people refinancing relatively quickly if interest rates fell. So in general, the balance sheet runoff is expected to be about I think $230 billion in treasuries, and I think about $158 billion in mortgage-backed securities. Or I should say somewhere between 150 billion to 200 billion for mortgage-backed securities, and then like 250 billion to 280 billion for Treasury runoff, and so that's about almost a $500 million that's going to run off from the Fed's balance sheet. Now there is some chatter in the markets now that the Fed may decide that they're not going to do that, and they're going to allow the balance sheet to remain very sizable and large. Not necessarily sure what effect that will have on the market going forward, because it doesn't ultimately slow. It doesn't put a cap on the trade deficit. In fact, given the fact that the labor market is extraordinarily strong, and disposable income keeps increasing, it probably just exacerbates the problem a little bit more further, so that feedback loop may not play out in where I think it's going to play out, which is Q3 of 2019, but it ultimately may play out in Q1, which kind of pushes the recession out to maybe Q3 or Q4 of 2020, as opposed to what I think was the base case for Q1 of 2020, because eventually that feedback loop has to come in, and it's going to play a part. So there are some other worst case scenarios for whether the market's going to be able to make that to absorb the issuance from both the Treasury and also the reduction in the balance sheet from the Fed. But I don't necessarily buy the argument that yields are going to go substantially higher. There is a possibility that conventional wisdom says, the Fed could be in a situation where it's too accommodative, and ultimately it pushes the dollar significantly down, which leads to interest rates being too low, which leads to foreign investors deciding that they can't get the risk return that they want because of the depreciation of the dollar, and also the yield doesn't compensate them fairly. But I don't think that's going to be the situation, given where global yields are in major economies, especially economies where they're running current account surpluses. U.S. yields are still substantially higher than where most of those economies are, and Germany being the perfect example. So there's still a lot of capital that would definitely chase into the U.S. market because of those interest rate differentials, even if interest rates were to come down more. And then the other thing I just want to touch on is the recession that I'm trying to predict here in 2020, and the twin deficit and how that kind of plays a role. So the rebalancing of the U.S. economy towards export growth is, I think, the biggest benefit of the 2020 recession. Tariffs and overheating economy eventually produce a feedback loop, and that's kind of what I'm getting at in terms of explaining the amount of current adjustments that are currently being absorbed by U.S. households and corporations. Eventually, that has a breaking point, right? Because it widens the trade deficit substantially, which again, given the twin deficit and the mandatory spending issues that we have with entitlement programs, you can kind of see that at some point that cycle is going to have to break, and we're going to have to go into a recession. But the other issue has to do with the fact that we've been in a 10-year expansion. So eventually, it feeds back through. So the soft data begins to reflect the hard data in Q3 2019. So I think some of the consumer expectations, some of the business expectations are going to start to go down and start to reflect where some of the soft data is going in where some of the hard data is going in terms of the economy slowing. So the feedback loop hits again I think in Q3 2019, leading to a decrease in demand, eventually lowering household and corporations import growth. Allowing exports of goods and services to close a trade balance in Q2 2020. And that's sort of kind of the rebalancing that needs to take place in the U.S., where I'm kind of making the argument that I think a recession actually is not necessarily a terrible thing. It's a good thing if it can rebalance the economy to where the U.S. is strategically, competitively advantaged. And the U.S. as a U.S. energy powerhouse could effectively benefit from the depreciation in the U.S. dollar and then rebalancing the economy over due to a recession that actually lowers consumer growth. So the downward adjustment in U.S. currency in Q2 2019 all the way to Q3 2020 allows that to happen. It also benefits the U.S. international investment income, which also means just a fancy way to say that U.S. corporations will, who are multinationals, will also ultimately benefit from an increase in national income due to the fact that the U.S. dollar depreciates, and the money that they're going to bring back is likely going to appreciate, is going to be worth more due to the U.S. dollar depreciating. So relating that to the stock market, obviously, I went out. If you listen to my forecast for 2020 2021. I had an 18% return on the S&P 500, and part of that plays into it. So the currency adjustment and the rebalancing taking place in the global economy is very vitally important, and possibly the reason the U.S. definitely should move into a recession in Q1 2020 and Q2. But eventually, U.S. federal deficit will force administration and Congress to cap spending and reduce the budget deficit. So going back to the twin deficit. So as we close the trade deficit, the U.S. is going to be forced to focus on the federal deficit. Again, mandatory spending is going to play a big part, and congressional caps on other spending is probably going to play a big part in reducing the size of the deficit. And there's probably going to be some tax considerations that a lot of people don't like in terms of raising revenue. Lower equity prices and a fall in wealth effect on the market is likely to shift more capital into assets like U.S. Treasuries, which again, given that initial argument, limits bond vigilantes, despite the twin deficit. Because the argument's always, well, twin deficit, it will force yields higher, crowding out effect. That's not likely to happen again, and I make the argument because there's substantial current account surpluses and global savings in the global economy. So there's enough foreigners to come into the U.S. market to keep yields relatively stable, and there's enough demand given the fact that the Federal Reserve is reducing its balance sheet from domestic banks to actually pick up some additional U.S. Treasuries. So the other big issue, I think, is the global current account adjustments. So the shifting of goods and services. Ultimately, China is going to open its capital account in 2020. So that's part of its 13th five-year plan. And it's also going to import more U.S. services, and those services could likely banking is going to make a big push into China from the U.S., but also tourism and education. Those are services that we don't often think about, but they actually provide a substantial U.S. surplus with China. And the other thing is that China naturally, given that it's shifting from fixed investment export-led growth to more of a consumption-led economy, it's going to be increasing its imports of U.S. energy and agricultural goods. It can't avoid doing that. So it's not a matter of the tariffs or not having the tariffs. China's economy is just going to be in a position where they have to import more U.S. energy and agricultural goods going forward. So the energy products, crude, LNG, LPG, NGLs and petroleum products, and also the fact that China is also trying to reduce its carbon footprint in terms of pollution and things like that. The U.S., obviously, because of the low sulfur and sweet crude slate that we have abundance of, and also liquefied natural gas, which we have abundance of, is going to play a much bigger role. And not only is that going to play a big role in China, but it's also going to play a big role in India. So India is likely going to be increasing goods imports in terms of importing more U.S. energy, crude, liquefied natural gas, liquefied petroleum gas, and NGLs, as well as petroleum products. So then, it goes back to the twin deficit. The last remaining part of that twin deficit, if the trade balance is able to come in because we reduce demand from consumers and households and businesses, the last part of that is the federal deficit, and how is the U.S. going to deal with the mandatory spending? You have some things that could happen. There could be a rise in mortality rates that actually would be technically a benefit to some of those entitlement programs. You also have the benefits of the U.S. Closing its current account deficit. So it may be in a situation where we see a substantial drop in the U.S. current account deficit. But again, to get to a surplus, you're going to have to, and to reduce the dependency on foreign savings, you're going to have to get to a point where the U.S. is in a position where the federal deficit is taken under control, and then that has obviously some side impacts, and it's obviously going to affect millennials and Gen Xers much more, and that goes back to where populism is ultimately going to be. So that's kind of where I have some of the twin deficit, the impact on 10-year treasuries. So ultimately, I'm saying that I don't think it's going to be a great impact and push yields higher. I don't see the 4.5% that JP Morgan has out there. I don't think that's very likely. Even with a strong labor market and increases in wages, and even if corporations were to pass the tariffs off to U.S. consumers and other corporations, it doesn't seem likely that that's going to generate substantial change in the 2% anchoring that's currently associated with inflation. And even if the Saudis were to, which I think they're going to do, is limit production in April, I don't think that that's going to have the impact of pushing inflation drastically higher and forcing bond vigilantes to step into U.S. Treasuries and force yields substantially higher, which is a good thing in terms of that third point out of the mandatory spending, but also the fact that the U.S. is going to be paying a substantial amount of coupons to foreigners, through the taxes that are left on spending. I'm sorry, not taxes, but through some of the debt. I said taxes, but I meant debt. So anyway, if you like this and you want to continue to listen, I'll have another one that kind of goes into details of why I think the U.S. is headed for a 2020 recession, and China's current account deficit in 2020 is probably inevitable. I think I laid out some of the arguments here. I think that could be a somewhat likely situation. There's a lot of things that could change that, but that will have an effect on the U.S. Equity market. And if you listen to my earlier videos, I think the U.S. is headed for maybe at best maybe a 5% return. 4 to 6% return in the equity market this year, and that's a very, very big range from 2,300 on the S&P to 3,000 on the S&P. And you can go back to that video and listen to it if you want to figure out what I said. But if you take all the videos into account, you can see that I'm building a case, and I think it's very logical, and the explanations are pretty easy to follow. And thanks for listening.